not on vacation. I'm sure that he would prefer. Would you vacation in Ohio?
Well, if you have family.
Actually, it's beautiful countryside, but I have a girlfriend, you know, people out there who go, oh, come visit, and I'm like,
Is that like I know in like Missouri?
you know what's funny? From about Ohio to Kansas, to me, that's just like a no man's land.
Yeah, it's this.
We drove, when I was a little girl, we got into the station wagon one year, my brother and I in the back seat, and we drove across country. And I can tell you, it was a very memorable trip, but not for all the right reasons.
Yeah. Well, he's got one less, Troy, the mayor, and now Jay, so yeah, here. Let's go. He's here today.
My husband is a firefighter, and so he spent the weekend helping everybody else. While my son and I sat home and froze. We have, you know, we have no electric, we have no heat.
You should have been pounding out flour for the hearth that cookies when you came home.
We've had an open Chinese restaurant. That sustained us for the weekend.
How they open?
We had pockets where we had pockets that never went out. There are three grocery stores that are close by. Two of them were functional, one of them was completely out. It still hasn't regained utilities. Out of the 5 schools, we had 2 out and 3 were fine. So it was just pockets, but we've still got areas in town which don't have utilities back. And we're saying tomorrow May, but
Well, some people are telling everybody here too. 11 p.m.
Here, November 3rd.
I mean, who knows, right? But I mean, you've got all these people.
Right.
Our next door neighbor, actually, the wire came off their house. And so even though the rest of the street is, he doesn't have it next door. And guy came knocking on my door trying to find him, and he'd get inside and actually shut down. Somehow the internal mechanism is still running, but the electricity isn't running. And he's telling me he needs to get inside to do something, and I'm like, well, I'm not letting you in the neighbor's house. Like, that's just weird.
Yeah.
And that you've got all these guys that came up from Missouri and different places, so the trucks aren't familiar to me, the man's not familiar to me, and I'm certainly not letting you into his house. He works for the road department, it's down the street. You can go find him.
starting to get depressing.
I can imagine.
It was from 2 months ago, about Woodbury. It's called the houses. And it was like, wow. Okay, well,
Yeah, water. I have no water.
You well,
I have nothing. No heat, nothing.
yeah.
Well, no, my sister lives in China. I mean, it's just a fact to get home. And then my wife gets home. Now you gotta run and you pick something up and you eat. And now you go and you have to invade somebody's space. You know, and then you get done and you come home and it's like 8:30. What are you gonna do? Let's go to bed.
Hey, in the dark?
talking to a client this morning, and he's staying with his daughter, and his son and his family staying with the same, like, there are like 18 of them in a, like, 3-bedroom house. And he's like, you know, it's fun to see family for a few days. Like, we're starting to get on each other's nerves.
Oh, yeah, 18.
I did find out though that Queen City has good food, some prices.
Queen City Diner.
Yeah, we went there for supper.
Yeah, no,
I like that place.
That's not bad.
Yeah.
I've been there.
I've been there for breakfast one time before, and
Yeah.
we were like, where do we go?
Someplace out of Emmaus.
I think it's clean too. It's a very clean place.
We have a senior center that right down the street from us. And the main common area had power, because they had a generator, but all the little units. So you got these 85-year-old people housed in the community center in the snow, and what do you get? Everyone
That's
falls.
not free.
So you had a couple people fall, you had a couple people who were on
It's essentially four.
electronically driven medical
And like,
support, who
I'm saying,
weren't faring very well. But, you know, all
Aaron,
these
have you been
years,
as well?
things, people never would have been out walking in the snow if they
Aaron.
were warm in their apartment, so.
He's pretty okay.
So I'll be missing out 3 days.
We had a water main break down there too. I don't know that it was related, but it was just more chaos.
I guess that's it. I guess nobody else is coming.
Yeah, might as well get rolling.
Let's get started.
All right, you promised to give us good news this time.
You obviously didn't look at all, did you?
All right, well, we'll start here on page 1, and,
We'll officially say that the pension board meeting is.
Cheryl? Can I point something out to you? Just be careful what you say. But no pressure.
Wait, now she's speechless. Wait a minute.
well, I was going to say something and
She's gonna make a
decided
motion to
not
adjourn.
to. All right, so, well, we all lived through July, August, and September, so it's not gonna be any surprise that we had a roller coaster ride for the markets. Equity market performance is listed in the top left. For the quarter, you see unpleasant double-digit negative returns for every asset class. If you remember, small cap had been outperforming. Small cap took the hardest hit. So the Russell 2000 was down about 22%. MSCI emerging markets down 22.5%, and the rest were between about 15 and 20. Large caps fared the best, the least amount of loss, around 13-14%. You know, but that really doesn't put in perspective what everybody went through in July. Now, I went on vacation in July with my uncle, who is a broker, my cousin, who's a director at JP Morgan, and myself. We're all in the industry, and we're all sitting in the beach house watching CNN, and literally mouth dropping, you know, negative 600. That was the weekend, negative 600, positive 600, negative 500, positive 500. And we were going back and forth all week. Makes you sick to your stomach, you know, not knowing what exactly is going on. And what it amounts to is the crisis of confidence. You know, there's a little bit of the debt discussion going on. There's a little bit of the euro crisis, you know, are they gonna have a bailout plan for Greece? What's gonna happen? Are they gonna write down the debt? Eventually, I think they do have to write down the debt. Haven't gotten there yet. But it's a crisis of confidence in leadership of Washington. It's a crisis of confidence that we're pulling out of this, you know, economic prolonged recovery? Is there gonna be a double-dip recession? So there's just all this like fear and panic. Now, the good news is confidence, or lack of confidence alone, is not capable of sinking the economy. If you think about it, consumer behavior is already very conservative. So people aren't gonna get that much more conservative. So if you were looking for some positives, you don't have a lot lower to go. You know, you look here, obviously utilities with best performers, some more defensive sectors did all right, and financials took a hard hit, materials, but again, that's manufacturing related. So, not really great as far as performance returns, but we were up and down and every which way in between throughout the quarter. If you look at the next page, fixed income. Of course, everybody's thinking going into this year, we're gonna have inflation, the Fed's gonna raise rates, things are gonna get back on track, and that investment grade corporates and treasuries are gonna lose money, because that's the environment that they don't do very well. Surprise, surprise. When we have a crisis in the markets, everybody seeks safety, and they start buying the treasuries and the high-grade corporates. Those actually fared all right. If you look at the performance here, it's actually positive for the quarter, and positive year-to-date, with the exception of high yield. So, interestingly enough, starting out the year, we thought fixed income was really going to lag, and it has actually produced positive returns. So, the good news, bad news here with the fixed income is, you know, credit spreads are actually tightening. You're not seeing a lot of returns still in any kind of treasury. As you know, the Fed came out to say, we're going to keep rates low for year eternity. And everybody's very disappointed. And I think the reason why they're disappointed with the Fed's announcement to keep rates low is that the way you stimulate the economy is to get people to go out and buy things because things are cheap, right? Because the interest rates are low, go out and buy a car, go out and buy a washing machine. Well, if the Fed says they're going to keep rates low for 2 years, what's the hurry? So people are sitting back, and I think that one of the flaws was that they actually announced a time period, so there's no urgency to the situation. No one's going to go out and say, oh, it's a great deal right now, let's go out and do it. You know, so that being said, everybody seems to be very disappointed in the Fed because they really haven't gotten some of the fundamental aspects of how to ignite an economy. It's not really working for them. So, we've got equities at lows. We've got fixed income just limping along here. What's the story? The opportunities are actually in equities. The dividend yield on the S&P 500 is actually greater than the dividend on investment grade bonds, fixed income right now. The Lumen Ag yield is lower than the S&P 500 dividend yield. So equities are still a better opportunity right now. The PE ratio, PEs, lowest PE in 21 years. So the market priced in a recession. There's not very high chance that we'll actually have a recession. So again, there's more opportunity in equities than fixed income. So, and of course everybody knows cash is returning essentially zero. So even with small inflation numbers, now the inflation numbers came out and the government has announced adjustments to Social Security, and all those inflation-adjusted payments are going up about 2.8%. They have announced some new contribution limits and things, so this is the first time in a couple of years they've actually acknowledged any type of inflation. Strangely though, the inflation is coming from the Fed raising rates. Inflation is coming from higher food prices because you have droughts in the Midwest and you have peanut crops wiped out and you have all kinds of things going on here that are affecting food supply. In addition, other energy uses for food crops, like soybean ethanol. But really, you're getting growing global population, growing wealth in emerging markets. And those people who used to always just eat grains are now starting to eat some of the more expensive foods, specifically proteins. So you're getting higher demand with no additional production globally. So the food prices are driving it a little bit. Obviously revenues are down across the board. So on the fringe, you're getting higher prices of doing business. You're doing higher prices, even things like dog licenses went from $7 to $21 in town. That's a substantial difference. Now, even though that in and of itself isn't a lot, you start adding up all the different things that are going up, and you are seeing some inflation, even though it's not considered a huge problem at this time. So there we are. Equity's looking better than fixed income. Large cap growth is probably, large cap in general and large cap growth are probably the best opportunities. And simply because multinational companies are more able to take advantage of different economies of scale, different currencies, and they are actually poised to do better. Right now, small companies, small businesses are probably hurting the most. And you can see small companies probably taking a larger hit. Part of that has to do with they've already taken the opportunities to refinance. They've already taken the opportunities to downsize and make efficiencies. And now they're at the point where if things don't pick up, a lot of them go out of business. So that's where we sit right now. The next 2 pages looking at the global economy and the overall outlook. Positive news is third quarter is actually supposed to show higher GDP than the first or second quarter. So we are not entering a recession. We're not in a recession. It's actually probably going to surprise on the upside. The third quarter productivity. You see lots of cash on the balance sheets. You see lots of healthy, large, multinational companies. It's not as if the sky is falling, but again, the confidence isn't there. So we really have lower prices than valuations should suggest. Europe. We've talked about the pigs, Portugal, Italy, Ireland, Greece, Spain, the Eurozone. Greece is a drop in the bucket. Their economy is actually shrinking. It shrank by over 7% last quarter. And the austerity plan, or the plan that they put into practice months ago that was supposed to address this problem, really focused on Greece growing itself out of its problem. But if your GDP is declining, I don't care what tax rate you have, but if no one's making money, you're not cutting your taxes, you're not going to make yourself whole. And the fact of the matter is, the industry that they have in Greece is not going to cut it. They're not going to be able to grow their economy in order to pull themselves out of the hole. Eventually what we feel is going to happen is they're going to have to write down the Greek debt. But this problem is a distraction. So people aren't feeling good about the economy as it is, and then all of a sudden, are we going to bail Greece out? What are the terms? Are the other financial industry globally going to be hit? There's all this what if, and then they announced a program the other day, and the market goes up. And then yesterday, Greece announced some austerity program that's going to prohibit the agreement from actually coming to fruition, and the market dumps. But you're on this roller coaster ride of tidbits of information here and there. You're not trading on fundamentals. It's all emotions. And really, the best thing for them to do is write off the debt, be done with it, and move on. Basically, underwrite
Who's holding the paper?
a lot of the other European banks. So,
Switzerland, Germany.
yep. And so here's the problem, is that they haven't accepted the fact that you're never going to get it. It's never going to work. And they can just throw money in it, It's actually cheaper for them to write down the debt and, as a sovereign unit, underwrite it and reissue it than it is to keep throwing money at it.
Are those who are holding the paper public public institutions or are those privately owned institutions or
Most are
commercially?
public. Most are public. There,
Taxpayers in those countries be paying off Greece's debt.
yes, yes. Well, here's the difference between Japan and Greece. In Japan, most of the debt was owned by the government and not outside the country. In Greece, the majority of the debt is not held within Greek institutions. It's held in the greater Europe Union. So, as you were saying, France and Germany and all those people are left holding the bag. In Japan, they've sustained a deflationary kind of, crooked economy for a long time, but nothing blows up because they're responsible for their own problem. The problem didn't actually start affecting all the other countries because nobody else was holding Japanese debt. So it's become a huge issue of focus, but the GDP of Greek adds less than 1% to global GDP. I mean, it's really minuscule on the scale of things. And even in MSCI fee, it's only a couple basis points, not even a full percentage. So again, even if you look at all the global economy, Greek is almost like a nothing. And it really just becomes more of how are the European countries going to handle this? And again, crisis of confidence. So that's the real contagion. That's the real issue. In the U.S., banks and financial institutions are being punished by additional regulations and legislation that's coming down. It's preventing them from making profits. I know Wells Fargo has identified we have lost the ability to make 4% of the profits that we made last year. So if we made profits of 6%, now our potential is only 2%. So banks are getting crushed, not necessarily because they're holding Greek or Spanish debt. They're getting crushed because regulations in the United States are changing. They're not allowing banks to trade for profit with their own money. They're not allowing certain operations to happen that have been happening that are profitable. So prohibiting profitability in many institutions. And that is being felt across the board. So that's where we are. People are still worried. You've got the unemployment problem. But here's the good news. With housing, unemployment, all these issues we keep talking about, the housing market is so low right now, essentially housing starts on the whole are 0. So you can't go lower. So inventories are already low in manufacturing companies. Housing starts are essentially flat, can't go any lower. So it's not gonna get worse because there is no way for you to go below 0 starts. Or 0 inventories. So it is looking like going forward, we will be in a better position.
Over what period of time?
Kind of like telling the homeless guy that the future's gonna be better because you're broke now and you don't have anything, so you can't go any worse.
Well, it's more looking at it is, are we gonna have a recession?
It can get worse.
Recession.
It can get worse.
But you're looking at, you can look at it from 2 ways. You can say, oh, everything's terrible and it's stagnant. But it's gotta do something eventually. And it's either gotta get worse or it's gotta get better. But it can only last like this for a certain amount of time. Right now, we're muddling through. And the way one economist put it was, the patient is still serious but not critical. So things are actually getting better, but you don't feel it because nobody's recognizing it. And if you're the person sitting there unemployed, it doesn't feel better. And it's really not happening quickly, and it's not happening universally. So again, if you live in, what did I see the other night, 60 Minutes, there's some town on the Montana, North Dakota
It's in
border.
North Dakota.
Williston? Is
Yeah,
it?
and that's where you can't even get a house.
You
because
can't get a house,
because of
there are
oil
like
industry and everything else.
thousands of jobs for every person that's there. They need 500 truck drivers and 1,500 oil rig operators because they've discovered a huge oil opportunity, and they don't have enough people to even service it. They don't have enough food stores to feed the people. They don't have enough housing. So I mean, unless you live there, Nebraska, the unemployment rate is very, very low. But you still got California, Nevada, Florida, where the unemployment rate is substantially higher. So the average, you know, is still close to 10%. Pennsylvania, I've seen a lot of research on Pennsylvania, and it's actually held up better than most of the states. And one of the reasons is that the housing prices didn't overinflate as much as they did in, say, New York or Connecticut. So, yeah, so, you know, when things don't overinflate as much, you have less to deflate. So overall, Pennsylvania is one of the states that's listed as having done better than the average. Again, it doesn't mean that everybody's winning. Right now, if you own a tree company and you live in New Jersey, you got a lot of work. You got a lot of income coming in for the next couple of weeks and from August through now. But, you know, as many people as have work, you know, just this recent storm has put several businesses out of commission. So the shop right down the street can't open, they can't make any money, but the tree guys make the money. So it's hit or miss, and we're in this kind of holding pattern of muddle through. So I can give you negative information. I can tell you that when situations are negative, you can find positives in opportunities, in equities, in high yield. But, you know, do I feel things are going to turn around in 10 days? Of course not.
You know, I was just gonna say, what is a reasonable expectation for the amount of time we're currently where we're at as opposed to, or then, or moving into the next phase where we start to get a little bit better?
Well, the magic number was 7. 7 lean years was the theme. So this started in '08, and so we're 9, 10, 11. So we're 3 years. We still got 3 to 4 years before we feel better.
Before we feel better in relation to the economy improving?
Yes, yes. And there's been a lot written on this, you know, more white papers than you can poke a stick at, but the theme is if people had not bailed, had not taken certain actions in Washington to bail out certain institutions or to, you know, try to do cash for clunkers or try to, you know, all these little patches, right? If all these things weren't done, it would have been very painful for many people, but we would have been recovering by now. Because you take the pain and you know, it's kind of survival of the fittest. The ones that don't survive, well, the rest of them move on, and everyone regroups. Unfortunately, that's not how it's handled, so a lot of the measures and actions that were taken in 2008 and 2009 to so-called save the economy, stimulate the economy, bring back jobs, all these different things may have made the recession less painful than it could have been, but also has prolonged recovery because they've, for instance, flooded the monetary system with money. They've created situations where nobody's loaning. So you've got housing. You can get a house now. I saw 3.78, 30-year fixed mortgage, conforming mortgage. Under 4%. All right, that sounds insane. But go try to qualify for that, because nobody owns. I mean, unless you owned your house for a long, long time, then you don't want to refinance because you don't have that much left to pay. But anybody who's got 20 years left on their loan probably bought their house when it was worth more than it is now. So you buy your house at $200,000, you take out a $180,000 loan. Your house is now worth $180,000. You can't refinance it. You refinance it broken legs, and you really need to sit back and say, maybe the best thing to do is not what we have been doing, these things are not working, so lay off and, you know, let things heal. You know, so, all in all, there are some pockets of opportunity. Again, emerging markets are still growing, they have low debt ratios, there are still lots of opportunities for growth there. Again, different global companies are able to take advantage. For instance, Coca-Cola, something like 75% of all their profits come from outside the US. So it's mostly coming now from China and India, and so if the US economy, people stop drinking Cokes, it's not gonna be that big of a deal. But those types of companies are much more poised to survive and continue to be very profitable in this environment. I've seen some interesting examples of companies like even Costco. They get more profits from membership dues than they do from selling merchandise. And 94% of all members renew their membership. And so little things like that, I know one of the funds holds it, and they were talking about Costco, and they were looking for these companies where the business model is almost guaranteeing a continued stream of income. So, again, Japan, interestingly enough, the yen has risen versus the dollar, gained strength, and they've actually had positive GDP growth. Of course, everybody's running around scrambling, trying to recover from a natural disaster, but it's stimulating their economy. So there are these strange things going on that have pockets of opportunity, but, you know, really right now, it's a matter of faith. And just, you have to have faith that things are going to get better, because otherwise you have no reason to be moving on. So in a way, you've got to find these positives, and equities are definitely selling at better prices than they have been. And you've got to see, you keep your money in cash, you know, they call it the mattress fund. You keep your money safe, you're going to miss out on opportunities in the long term. So as far as these portfolios, we want to continue to be invested. We want to continue to, you know, have faith in the long term that all of the things that we have always told ourselves are true happen.
Sure, I was saying that was the same, but I'm going to. But are there bodies of experts in the financial sector that are opining that the decrease in current values, what they are now, say in housing, say in equity, any of them say that they think that this has been a correction, and that the values that we're seeing now are appropriate values, and that over the last, say, 10 years, what we've seen is an overvaluation of those assets?
Yes and no. I think specifically to housing, yes. There was a bubble, and you know now people are saying there's constant bubble. There's a tech bubble, then there's a housing bubble. Now do we have a gold bubble? That's kind of the theme. Now whether we do or don't is the point, but there's always something that's being overinflated.
But how about
However,
in terms of equities themselves? Across the board, looking at the
across
value
the
of
board,
equities.
equities, companies that you own that actually produce things, that actually are capable of making profits, no, they think that they're way too overvalued. As far as a house doesn't, I remember once years ago hearing something that a house is not an investment, a house is a place to live. And you kind of go, And then, of course, everybody forgets that concept during a housing bubble. You're back to the fact that a house it's a liability. By the time you put in all your maintenance, your upkeep, your utilities, in most periods of time, renting is a better option than owning, financially, not necessarily for community support, but financially it's a better move. Because if actually an investment, it's a very poor investment. I mean, the housing values today, again, it's more about credit and it's more about perceived rent. I know houses in our town are still selling very rapidly at much lower prices, but we're right on the main line to Manhattan. As long as somebody has a job, great school system for the dollar and easy access to jobs. So it's, I don't know that anybody has the real answer. You've seen people on both sides of the pendulum. I know even internally, we have economists that are more optimistic than other. I could hear two economists internally, and the guy from Wealth says one thing and the guy from brokerage says another thing. Even though they're all looking at the same statistics, different shades of gray. The one I feel pretty good when I actually listen. Okay, things are all right. And then the next one you listen to and you feel like you've got to go out and, put your head in the sand. And so, overall though, the consensus is the slow but steady. I don't think many people think that the chance of global recession or domestic recession is possible. Is European recession possible? Yes. So again, a lot of this is regional, a lot of this is just muddling through until we get to a point where things stabilize. There have been people who've written books, and I've been trying to think of the name of the book since I asked that question, predicting the end of the world as we know it. And put all your money into cash and, the world, the sky is falling. You've definitely got those people out there. Aftershocks. I think that's the name of the book, Aftershocks. And you've also got people, now this is my biggest fear is inflation, quite honestly. And what inflation does to the value of what you own. So you save all your life and you have $500,000 and you expect to retire on that. But if that $500,000 can only buy $200,000 could 10 years ago, you're still screwed. And my biggest fear is you're doing all the right things and you still end up feeling like you've got nothing because the value of your dollar has declined. Davis.
Would it be more screwed on what your final exam you still pass?
Depends on the professor. I went to Dickinson College for my economics degree, so. So, I think the situation is you've got people like Art Laffer, who, I don't know if you ever heard the Laffer curve, talks about the more you tax, the less money you are. So there was a point of maximum taxation. That's what the Laffer curve is about. And a lot of people blow it off and say, no, that's not right. You tax 8%, you pay more tax revenue than if you taxed it 40%. But he's saying, no, there's a point where people aren't going to find it worth the effort to make money because they're going to end up with too much of that profit. And he put out a book, probably a little prematurely, I want to say 2009, that talked about inflation coming like we have never seen. And I think this is the biggest problem because our dollar has been devalued by all the money flooding into the system. There's no telling. So right now we're in a holding pattern. All the rates are low, things are being kept artificially low. But what happens when the rates start going up? You're going to have people raising prices faster than rates go up. So rates go 1%, every prices are going to go up 2%. I mean, I'm not talking about the peanut crop being wiped out, the price of peanut butter doubling, because that's an isolated incident. But all in all, you've got tons of people just waiting for an opportunity that can't possibly, in this environment, increase prices. But give them an opportunity to be able to sell at a higher price, and are bound to see higher prices across the board. The only thing that flies in the face of that is wages. Wages are the largest component of inflation for corporations and for, so if wages don't grow, that's the only thing that keeps it in check. But it keeps us all down. Because you know, you don't make more wages and what you're making for is less. You're still in this mode of trying to be conservative. So there's where we are. Again, I don't think that there are several bright spots. I listened to this whole lecture on telecom, media, and the consumer industry are all merging into one big blob. Because when you get your little iPod and you buy your stuff from Target and you know, become friends with Starbucks and you do all these things, you as a consumer, this is now a consumer tool, a media tool where you're getting all your news and media, and also a telecommunications tool. So those industries are all merging and there are huge opportunities there. The amount of demand for those type of smartphones and types of iPads is exceeding supply. So there's an amazing potential there for not just the companies that make them, but a lot of other companies as a result of this. So that is one of the areas, you know, one of the managers was talking about, he's focusing on this area for growth. So a lot of his holdings are companies that benefit in some way from new technology. Because, you know, my mom was saying the other day, I don't get it. She has like the landline, you know, all the stuff we all had. The landline, the cable TV, the internet, and now a cell phone. And she's like, how can anybody afford, you know, these cell phone plans and these data plans and all these things for $80 a month? I said, well, Mom, you don't have an internet connection. You're getting everything through your phone. You're paying for your phone, the internet on your phone, and you don't have your, you know, your landline and your cell phone. You got rid of your landline. So there are people today are spending their dollars differently than people were before. And the design doesn't mean you need to have all of the things. You're picking and choosing, and now you're picking new things, new bundles.
So overall, how does all this, what you've been leading up to, relate to what we have in the pension plan?
Well, let's look at page 5. I think bottom line is that we want to stay 60-40. We want to stay on course. I don't care what studies you look at, every recovery, they're never straight up. And as we go down, as we go up, you want to have the fixed income to buffer you on the way down. You want to have the equities to take advantage of things when they do turn. 60-40 is probably the best situation. If you look at September 30, the first plan that's listed is the police plan. It's right around the 60-40 mark, 58.40, right before it was rebalanced. The rebalance the first business day after the end of the quarter. So that's the deviation, not very far off. If you flip through, there's a pie chart showing the same thing, 60-40. Page 7 shows the asset allocation, and again, as a percentage of equities, as a percentage of fixed income, what we're looking at, just over $4 million in the plan, $4,034,951. And if you look at the next page, it shows cash flow, starting out with $4,597,868 for the 3-month period. Contributions and withdrawals, it was negative $60,204. It's a little higher. You know, for the year to date, we're down 217,000 for withdrawals. This is contributions. Investment gains, that's where we got hit, the 3-month period, down close to 500,000 at 493,713. But if you look at the 1 year, it doesn't look as bad. So for the full 12 months, we're not doing as poorly as it looks like in this quarter. This quarter, we really got killed. Ending market value, 4,034,1. Question? And the performance is on page 9. For the 3 months, negative 10.93, year-to-date, negative 6.71. The full year, you're almost flat, negative 0.9. 5 years, 3 years, up 5% annualized. So the hit was in the equities, fixed income portfolio actually gained. So that 40% fixed income actually offset losses in equities. Now we're hoping we'll pass the most volatile period, but I think volatility is going to be more at least 20 years this year. If you're curious about the underlying performance of any of the funds, that is listed on page 10 and 11. Then if you flip through past the yellow sheet of paper, the employees pension plan. Again, a 60-40 mix. You can fast forward through the next 2 pages. Page 7 is the breakdown of the asset allocations. And then page 8 is the cash flow. Beginning market value here was $3,061,986, with a withdrawal amount for the quarter of $36,916. Investment loss of $329,006, leaving you with $2,696,064. So right under. And the percentages translated into percentages on page 9. 3 months, very similar again. Portfolios are similar. Negative 10.9. Year-to-date, negative 6.7. The 1 year, which is 12 months, is 1 basis point different than the other plan, negative 0.89. And then the longer term doesn't deviate from that. Any questions? The only thing that's in the back here is actually a fact sheet for every single fund that's in the underlying investments. Top holdings, breaks down by countries, breaks down by everything, and an appendix. So that's all I have officially. This is all, it's definitely not a period of time where people feel good. But again, I think we have to keep the faith that it really has to get better from here. And equities are valued below fundamental value.
Especially for all the money that.
Well,
The
for a long
balance.
time, I don't make a lot of changes in my own accounts, but ever since July, I've been thinking, I should reallocate my son's 529 plan. I still have about 10 years to go for him. And I reallocated it yesterday. The trades went through yesterday. So I moved out of fixed income because I had all these conservative things and put it into equities. And it was good because I was buying lows yesterday. But I mean, you can't time it because when you put it in, it actually trades the following day. So I couldn't have, I had no crystal ball.
Right.
Well, luckily I was at the lower end, and I've been occasionally throwing, like, the market's down, I'll put an extra $100 in. I'll try to scrape up a little bit of money because I'm like, it's down, it's maybe just a little more. So, other than that, high yield, a little bit of emerging markets debt, if you have access to that, and equities. Now, again, lots of studies have shown you actually can make more money in an inflationary period betting on equities, because companies have pricing power, than fixed income. So again, another are looking for income paying stocks actually are paying better dividends than you investing in the Lehman Ag or quality fixed income. So, you know, the retirees out there, people looking for income, you actually better bet to buy equities and be living off the dividends. And there's a man out there who has a list of all best dividend paying companies, and they're all, you know, prime suspects that you've seen, you know, the McDonald's, the Johnson & Johnson, the Procter & Gamble. But you can create a portfolio and live off the dividends, and you're gonna be making more income than if you invested in fixed income in this environment. And I don't think that's gonna change very quickly. So. Any other specific questions?
I got one.
You know my phone number.
Stay the course.
Stay the course. At the end of the day, you know, interestingly, when did I meet with Chuck Royce? He runs all the Royce funds, small cap investing. Now Chuck Royce he must be 90, and he actually lives in this little brick building that is about 3 feet away from the building his office is in. So you can see into the office from his living room and, you know, poke his head around. But he still actually manages money, and I met with him in early 2008, and he was hoarding cash at that point. And in the beginning of 2009, he went from 14% cash to 3% cash, because he just said, you know what, I'm doing this a really long time, and the only thing that I know is true is buying things when they're cheaper is a better idea than buying them when they're expensive. And so he had hoarded all his cash because he just felt like there was nothing out there that was cheap enough for him to buy. And then he finally decided things are cheap and put all his money to use. And the fund did fantastically in 2009, 2010. You know, it's those things that you, when you're in this industry, that you have to keep remembering that this guy has been in this business longer than anybody else, and keep a cool head and think straight. And when it feels like you don't want to put any more money into that 529 plan, you put the $100 in instead of going out for your anniversary dinner because you know it's the right thing to do. And you know, so we had pizza for our anniversary, by the way. Huh?
At least got some topics.
Sauce, cheese.
No, but we did splurge on the soup with it. We got soup and pizza. Actually, my husband, during the hurricane, cut down a neighbor's tree that had fallen in front of the garage because he has a chainsaw. And then we hooked our generator up to another house who was filling with water, so we were sharing it. And both neighbors gave us things, bottles of wine. So the neighbor gave us a $40 gift certificate for the local pizza place. And our anniversary, which was a weekend ago, I was like, I don't want to spend money because I don't want to spend money either. So we pulled out the gift certificate and we took my son down there and we all went out for some pizza.
Nice.
That's the way to do it.
And I think we paid like $10 in tip, like that was it.
All right, Cheryl, thank you.
All right, well, we'll see you, and the dates for next year, you can talk to Dave about.